Welcome, everyone, to the 377th Thalesians seminar. We are live out of London on the 22nd of September. As per our tradition, I'll start by announcing the forthcoming seminars or webinars as they currently are during the pandemic. On the 13th of October, we have Bruna Bouchard-Denise, who will talk about Dupere-Ito's formula for CO1 path-dependent functional and regularity of path-dependent PDEs. On the 20th of October, we have Agatha Murgocci, a talk dedicated to the memory of Thomas Bjork, who, as you know, has passed away, and the title of this talk is To Be Confirmed. Marek Kapinski will talk on the 27th of October, and the title is To Be Announced. And on the 3rd of November, Peter Korn will talk about deep order flow imbalance, applications of neural networks to the extraction of alpha at multiple horizons from the limit order book. On the 10th of November, Andrea Barbon will talk about gamma fragility. The talk is organized by Hans-Peter Schreil. So you can sign up for these seminars, for the Thalesian seminars and meetup by following this link at the bottom of this page. And today we are honored by the presence of Bilal Hafeez, the founder and CEO of Macro Hive, a leading independent research firm. Prior to Macro Hive, Bilal was global head of international fixed income strategy at Nomura between 2016 and 2019. Before that, Bilal held various senior roles at Deutsche Bank between 2002 and 2015, including head of multi-asset research. He was advisor to the CEO, head of Asia research in Singapore, and global head of foreign exchange research. Bilal started his career at JP Morgan in 1998. During his sell-side career, Bilal was rated #1 market strategist by Euromoney and institutional investor for most years between 2004 and 2013. He also pioneered FX investment and smart beta benchmarks. Academically, Bilal was an honorary visiting professor of finance at Cass Business School. He studied economics at St. John's College, Cambridge. Bilal has 7 cats, 4 chickens, a beehive, and 1 dog. Now, he represents a company called Macro Hive, which is the community platform for the thinking investor, where the world's most sophisticated investors get their research. You can follow Macro Hive by going macrohive.com. Now, just a quick comment. If you would like to ask questions, you can ask questions throughout the talk on the chat. We'll address them at the end of the talk. And you can basically paste your questions on the chat. The other option that you have, if you want to ask your question in person, you can raise your hand and then we will unmute you and then you can ask your question in a live dialogue after the talk, at the end of the talk. So I think that's all I had to say. It's an honor and privilege to welcome Bilal today. And without further ado, over to Bilal.
Great, Paul. Thank you very much for the very nice introduction, and welcome everyone to who've very kindly taken time to listen to me. Now, the first thing I have to say is there won't be any formulas in my presentation. It won't be as complex as the next one on the Dupere-Ito formulation. And so you'll have to forgive me if this isn't technical enough for everyone. But the one thing I would say is, I do currently work with quants very closely. And in my career, I've worked with quants throughout my career in trying to come up with models and ways of pricing markets and trying to extract alpha in markets as well. Now, in this presentation, what I really wanted to talk about was really, in some ways, this is, a kind of a summary of the way I approach quant. And, I have more of a macro background, so I kind of bring kind of this macro perspective to quant. And some of the things I'm talking about are some of the lessons I picked up when I have worked with quants, where I feel quants who come from a very technical background often have certain blind spots and they don't quite appreciate the importance of certain issues. So I'm going to run through three of the big ones, I think, that we all try to grapple with, whether you're on the macro side or on the quant side. So let me share my screen, and hopefully this works. Yep, so hopefully you can see this. And essentially the three important issues I think we all have to deal with is, first is the data problem, the second is the explanation problem, and the third is the regime problem. And they're all kind of interrelated one way or the other. On the data side, which I'll start with, one of the things I find is that people who have a very strong quantitative background like to almost bypass the data side, or they get the data set and they want to very quickly move on to the technical, the more fun side of the work, where it's about applying the latest techniques that you have, using machine learning perhaps, and crunching the numbers. That's where their heart is. The problem with that is if your data is bad in some form, then it doesn't matter how good your model is or your framework is, the output will also be bad. So that's a garbage in, garbage out issue. And I find the biggest issue I find in the quant space is people don't work with data in the correct way. Often the data is incorrect in various forms, or the data hasn't been transformed in the right way, or they don't understand the sources of the data. And so in some ways, the best mix of people I find is to combine somebody who understands the data really, really well and couple them up with someone with very strong quant skills. And together, that's a very powerful combination. And I think often quant teams are too skewed towards the pure quant side and away from people who really understand the data that they're working with. And let me give you some examples of some of the errors people make when they work with data. And I'm going to primarily focus on economics or financial data, but this can also apply to other data as well. Now, the first issue is when you work with macro data, the data is heavily revised over time. And often they get revised heavily around turning points in the business cycle. And this is important because often it's turning points in the cycles that people try to use their models to predict in some ways, because it's obviously the turning points of recessions and booms that you're trying to call turns in. The issue here is that if you go to a database, whichever database you're using, Bloomberg, Reuters, whichever Refinitiv, Macrobond, Haver, and so on, if you download a time series of, say, US GDP or US payrolls, that will show you the latest vintage of the historic time series, but it won't give you necessarily the point in time data that you would have seen in real time at that time. So an example here is if we look at US GDP. So if we look at, say, Q4, so this is during the height of the Lehman crisis, the global financial crisis, which was in Q4 2008, the very first estimate of GDP annualized for that quarter for Q4 was around 3.5%. And that data came out in January 2009. So the very first estimates of policymakers, people who were using models, their estimate, if they were using GDP as an input, the first value would have been 3.5%. However, a month later, the second iteration, the second revision of GDP comes out, which is usually the second month after the quarter. And that showed actually it wasn't a 3.5% decline. It was actually a 6% decline. And now in later years, you get benchmark revisions of GDP. And it turns out the actual growth in that quarter was minus 8%. So the initial estimate of growth during that quarter was minus 3.5%, which you would have known in soon after the quarter. But in reality, the true number was actually minus 8%. But you would only have known that in later years. And if you're working with GDP time series, the data you'd be working on with your models looking at Q4 GDP would be this number here, when in reality, the data you would have had early on after the quarter would have been this data point here. So if you don't get the correct what's called vintage data, then you'll actually be using the wrong data inputs in your models, because you'll have data that wouldn't not have been available to you at that point in time. And in order to get this historic data, there are some databases that provide you the correct vintages. Otherwise, you have to manually go through and see what the actual data points were around that time. The same applies to payrolls, which is probably the most market impactful data series that you have, where you see that the first version of the numbers of payrolls, say for November, let's say for October, was minus 250,000 decline in payrolls in October of 2008. The actual number turned out to be closer to minus 500,000. But you would only have known this in later years, that was a true number. So you would have, if you were using this number, it's not the correct point in time data. So the first thing to note is you have to understand the data. You have to understand whether you're working with revised data, unrevised data, and also you have to understand when that data comes out. So if you simply download data, Q4 GDP in a database will come out as 31st December of that year, 2008, but you only get that data at the end of January the following month, January 30th, 2009. So you have to have the correct date. You would have had that data available for you. So you have to understand the revisions, and you have to understand when the data was released in order to have the correct dates and values for your models when you're running them. Another common issue I find when people work with models is that they don't know which financial series to use, and often they use the incorrect one. Perhaps the crucial one is interest rates, because interest rates are the critical input you need in almost all models that you work with, because you need to always work excess returns, and the excess returns are usually above the short-term interest rates. The question is, which short-term interest rate should you look at? And so what I've done here is I've looked at 6 different types of interest rates for the US market. This includes, US interbank rates, there's repo GC rates, there's deposit rates, there's treasury bill rates, there's the Fed target rate, there's OIS. So these are 6 different short-term interest rates. But especially during crisis points, they can give you wildly different numbers. So for example, during the global financial crisis, if you, in your models, were using US OIS 3-month interest rates as your funding for your models, your interest rate that you would be paying would be 1%, which would not be such a big deal for your models. However, if you look at LIBOR and pool rates, which is probably closer to what you would actually have to be paid in the funding market, because as somebody who's not doesn't have access to the Fed window, you wouldn't be able to access the rates that the Fed can offer. You instead have to go through a bank, and you have to then access the interbank rate. You would have found that your funding costs would have shot up to 6%. And when you get this type of move in your funding costs, this could wipe out your model returns. And the same thing we found also during COVID, where you found LIBOR rates decouple significantly from where OIS rates were. But also on the repo side, we had the repo crisis in 2019, where repo rates shot higher. Whereas in, say, 2008, repo rates stayed well behaved. They stayed pretty much close to the OIS rate. However, in 2019, and even 2018, you found the repo rate blew up as well. So again, depending what model you're using, depending which interest rate you use for your models, you could end up with very different returns. And that could have an impact on whether your model is really sustainable or not. And this can get very technical, and you have to really understand what interest rate you have access to. And this applies to other time series as well. Often people, when they look at equity returns, they might not include dividends correctly. They may not roll the dividends at the right point. When they look at futures data, they may not link the futures contracts correctly, which will affect how you calculate the roll and so on. So there's a lot of work you have to do in terms of using the right time series, and then also interpreting that time series as well. The third issue on the data side is perhaps the data is just inaccurate. It doesn't give you a true representation of what it's supposed to do. An example here, a classic one, is China, where this chart here shows you Chinese GDP. So the orange line is China, official data from China, which shows year-on-year change in GDP growth. So this is a classic kind of benchmark measure of growth. And what you see is outside of crises, like the COVID period, it's remarkably stable. So it's almost just a straight line. It's almost as if China between 2010 and 2019 didn't have a business cycle. The growth rate was just a straight, smooth line. And that should make you suspicious. No economy can just run at such a stable rate. Now, if you use an alternative measure of Chinese growth, and we have our own models at Macro Hive where we built different versions of Chinese growth, and this model here in the blue line uses different forms of hard data from China. So things like electricity prices, electricity usage, freight rates, freight traffic, I should say, new orders from survey data, and we combine it all together. And there you see there is more for business cycle in China. So there was a sharp in GDP suggested. Also in 2015, our one in the Chinese economy, which wasn't shown up in GDP data. And that was a period, which we saw China-related weakness. So again, this tells you that the you work with is very important, and often the data may not be accurate, in which case you need to come up with proxies that more accurately represent whatever it is you're trying to measure. So these are some of my kind of experiences on the data side. And I would say that, one piece of advice I'd have to anyone in quant space is you need to really spend much more time on the data one is working with. Now, the second issue we always have is the explanation problem, which is when you have a time series of data, do you need to have some kind of theory or narrative around what that data should tell you or not? Or can you just work with the time series by itself? So you don't need a theory, or you don't need an explanation or narrative. And I'll argue that you always need some kind of explanation. And even if you think you don't have a theory or explanation, you do implicitly have one, whether it's saying that there is no explanation. That is a theory in itself. One way of kind of putting this in quite stark terms is if I show you these two time series. So this is true time series of different markets. So this one here, they're both rebased to 100. And you see this one here goes up very significantly to 400, so it's gone up significantly, 300-400% or so. Now this one here, similar sort of time period, you could say, and it goes sideways. And so when you're building your models, if you have a choice between these two markets, which market would you think is more attractive to invest in? Now, if we were in an in-person setting, I would ask people to vote which market they would invest in, and most people would say that they'd avoid market 2, and instead they would vote that market 1 is the best market to invest in. The problem with that is these are the same markets. This is US stocks. The difference is this is US stocks during the 1910s, and this is US stocks during the 1990s. So it's the same market we're looking at, just different time periods. Yet by looking at this time series, you say, actually, US equities are not. This market's not an attractive one to invest in, but this one is, but they're actually the same market. You're looking at different time periods. So this, and what I'm trying to get at here is that when you just look at a time series without any explanation, any context, you're very likely to misinterpret what you're reading. And so in this case, what the context is this is actually the same market with different time periods. And so as soon as you realize actually it's the same time period, then you say, okay, hang on. So why is it that in the 1990s stocks went up, but in the 1910s it doesn't? And then that leads on to investigations for you to have to formulate some kind of theory or explanation about why that's the case. Looking at the time series itself won't really tell you that. And so you always need to have some kind of context or explanation to work with in order to interpret the data. Otherwise, you'll just be data mining all of the time. Another way of looking at this is, and sticking with equities, if you look at this chart here, this is a chart of Apple, the tech company, and you see that over the last 10, 20 years, Apple stock prices has really just rocketed higher. And when you look at this chart, you'll look at it and think either looks like a bubble, so I don't want to invest in it. So you'll kind of think that this explosive market is not that attractive to invest in. Or you could say, I'll just follow this market all of the time because it's always going up. So if you just look at that time series by itself, you'll have, one of the two ideas about whether you want to invest in it. And then you can massage the data however you want, but in essence, what this will tell you is you want to be long this market because it's explosive sort of growth. But if we start to add some theory or some explanations to this, we know that stock prices have a relationship with earnings. We may not be sure exactly how they map to each other, but we know they're linked in some ways. And so if we adjust the Apple stock price with its earnings, so we look at the PE ratio, we see suddenly this kind of explosive sort of growth over here suddenly doesn't look as dramatic. In fact, the current PE ratio of Apple is similar as the historical average over that time period. And there's been numerous instances where the PE ratio has been much, much higher. So we're introducing an explanational theory into the equation to try to understand Apple stocks. On top of that, we can then also incorporate bond yields. So what we do is we look at the inverse of the PE ratio, so the earnings yield, subtract it from Treasury bond yield to see whether the earnings yield of Apple is providing an excess return above Treasury yields. And there you find that currently it is above the average. And the excess earnings yield is actually much higher than it was during the 2000s, which would then tell you that even though Apple stock prices is trading at such high levels, looking at these metrics, it may not be as extreme. Now, you may disagree with how stock prices are mapped to earnings or to bond yields, and there's unstable relationships. But the point here is what we're doing is we're starting to add more and more pieces of the puzzle to try to understand what drives stock prices. And through that larger narratives, explanations, or theories, we can start to work with the data in a much more meaningful way rather than just working with a time series by itself without any context, in which case you could end up making some quite serious mistakes. Now, the final thing I wanted to mention, which in some ways is the kind of the holy grail issue, is the regime problem, which is that no matter how robust your modeling work is, no matter how good you're doing your testing and so on, ultimately, you're making some assumptions about the regime that you're in. So whatever time period you've done your back testing, your out-sample, in-sample testing, and whatever, you're basically working to a certain regime that you're assuming will continue in the future. And even if you have an idea of how the regime could switch, you're making the assumption that how the regimes are going to unfold in some future period. And that's a big, big challenge. Often we do so much great work on our quant models, but ultimately they just work in one regime. And when the regime changes, they stop working. Now, a classic example of this is trending or ranging markets. So this, to give kind of an example of this, what I do here is I look at the Russell 2000 US Small Caps Index, which has exhibited some strong trends and some ranges. And the orange line is a very simple trading model, a short-term trading model, where you go long the Russell 2000 when it's above its 20-day moving average, and you sell it when it's below its 20-day moving average. And what you see is that with a very fast-turning model like this, it did very well during the COVID period here. When stocks collapsed during COVID, the model very quickly flipped to go short Russell, and it made a killing, made a 40% return or so, over that period. Then went sideways, and then it started to give back those returns, especially when the market started to range. But the more interesting period is this one here over the last 6-7 months, where the Russell 2000, after trending up here, and this model did very well, it's been in a range for the last 6 months. And during that time, this trend following model has been flip-flopped all the way to give you poor returns. So every time stocks go up, it starts to buy, but then stocks go back down to the lower end of its range and it gets chopped up and the model starts to underperform. So, in the end, this type of model, a trend model, only works if the market is trending. The question then is, how do you know if the market is trending, if you're in a market that's going to be trending, or if you're in a market that's going to be in a range? Now, there's no simple answer to that all, but, we can, come up with some ad hoc explanations in this case. So, for example, this period here where the model made strong gains when markets collapsed, but then it started to lose when markets recovered, that essentially was the period where COVID cases peaked in Italy in around March 2020. And as soon as that happened, markets started to rally. So there was a big turnaround point. So if one was able to understand that a big driver of the market collapse last year was driven by COVID, then if you had a COVID factor, you'd understand that there'd be a switch in the performance of markets when COVID had stabilized. Equally, when you look at this ranging period that we've had since March 2021, that coincided with the peak in US activity and growth numbers. So US growth numbers bounced significantly, but around February, March of this year, they stopped going up. And there's lots of different reasons for that, but essentially growth numbers started to come back down. And over that period, suddenly stocks, like small cap stocks, which are heavily tied to the real economy, started to go sideways. So had one, use some kind of cyclical measure as a conditioning variable to condition when you use your trending model, that could have given you some indication of when the market would enter a range or not. But the point here is that, there are models work in certain regimes, and it's very important to understand what regimes you're in. And ultimately, many quant models are either do well in trending markets or do well in ranging markets. And to understand whether you're in one regime or the other, it helps a lot to try to understand what causes these regime shifts. And if one can spend perhaps more time on understanding when the regime shifts, rather than trying to optimize your trending model or optimizing your ranging model, then often you can end up with much better alpha. So this is kind of a very sort of whistle-stop tour of some of the things I picked up over the years when I've worked in the quant space. And just to kind of summarize them, the biggest thing I would say is the data side of quant work is incredibly important, and lots of mistakes are made there, which later take up a lot of time to fix. The second is it's very important to have explanations, narratives, of theories about the data you're working with and the thing you're trying to test. And the third thing is it's really important to understand that often we're optimizing for a certain regime. And so when that regime shifts, whatever model we've come up with just won't work. And so understanding regime shifts is very, very important. And unfortunately, there's no easy answer to understand when regimes will shift. But nevertheless, that's often the thing that will really impact your returns the most when the regime shifts. Okay, so what I'll do is I'll stop there, and then we can start. I could take any questions if people have any. I see we have a whole sort of bunch of people on the call. So I think, Paul, I think you were going to. So if people have any questions, do either put it on chat or raise your hand.
So from what I can see, there are no questions on the chat. But are there any raised hands? Okay, so there is a question from Saeed, so let me unmute Saeed.
Sure, thanks for your talk. I really enjoyed it. I think one question I have in particular is that, do you think quants overweight trend models? And maybe it's just a data issue because it's easier to create a trend following model. So you don't have to fiddle with any of the macro data. Do you think that's probably one reason why they like trend?
Yeah, no, that's a good question, and I think they do. Most quants work in kind of a trending environment. I think often it's also because many of the most successful quant models do come from the equity space, where obviously over time equities do go up. In fixed income and in FX, it's probably a bit more balanced. But I would say there's a preponderance of trend. That does dominate the space, and I think that's particularly problematic, obviously, when you enter a ranging environment, because everyone's optimized for trends. But markets have trended very strongly for the last 20, 30 years, either on the bond side and equity side, and so that naturally I think skews everyone towards trend. But I do think that sort of dominates everything.
We have a question on the chat. Thanks for a presentation. Are there good papers or books that you can recommend on regime-based asset allocation?
Yeah, no, that's a good question. I mean, nothing kind of comes to mind. I mean, the thing here, I would say, is that I think you just have to read around the subject a lot. What I find very useful is to read books on history of financial markets. Whether that's the McKay book or Galbraith's books on crisis and so on. That gives you a sense, a very visceral sense of how markets can move from one environment to the other. So I think that's very helpful. I think a lot of the work that Taleb has done, in terms of black swans, that's very useful to understand when you move from a normal distribution world to a power distribution world. So that provides all of those types of books, history books and the Taleb type books, that kind of gives you a lot of almost confidence to understand that regimes can change, even though it feels like we've been in the same regime for the last 30, 40 years. Then on the more technical side, I think there's been lots of good work in the machine learning space, and also in the more traditionally in the Markov switching models. And there's a whole bunch of, sort of books on that side. But I would say that I would say kind of read history a lot more, and that kind of gives you more of a visceral sense of how regimes sort of shift. And then in the end, also, my general bias with these sorts of things is do a lot of the homework yourself and just do very simple things. So, for example, look at how different asset classes behaved in high inflation environments, low inflation environments in different countries over the last 30 or 40 years, so that you get a feel for the data. And then you can start applying more technical, features to operationalize it.
Another question in the chat. I'm a recent BCom graduate. How can I get into quant industry? Are there any courses, programs that you would recommend?
Yeah, no, that's a very good question. I mean, I think if you want to get onto, the quant side, I think these days it's a very competitive field. I think it's essential to have very good coding skills. Python's a big one at the moment. And related to that, I think one needs these days to have a very solid kind of machine learning understanding as well. I would also say understanding econometrics and statistics is very important, because I feel sometimes if people come into quant with a pure programming background, they don't quite appreciate the subtleties of working with time series, which works quite well in econometrics. As to which courses and universities, I think all the credible universities and do great courses on this, and there's some great online courses as well that are available. But I would say some kind of Python course, some kind of machine learning course, some kind of econometrics course are kind of the blocks that you need. And then I think it's important to kind of work on projects on the side all the time, build up some code in GitHub or something so you can share it with people. And I think that would be the way to go forward.
I missed an earlier question in the chat. Are you effectively advocating quant models plus discretionary overlay?
No, that's a good question. I mean, I think quant with discretionary overlay can work. I mean, the challenge with discretionary overlay is that you could end up being quite schizophrenic, because every time you disagree with a model, you'll override it, and in the end, it might just become a whole discretionary portfolio. What I advocate instead is you can do quant with discretionary overlay, but also you can have a pure quant approach, but you use discretionary insights to inform you about which models will work well or not. So often people with a pure quant background will optimize for Sharpe ratio. So they'll pick a model with a very high Sharpe ratio or Sortino ratio because it's the highest number. But someone with more experience or more discretionary understanding may actually say, the one with half the Sharpe ratio is better because it's based on a clearer narrative of what's driving markets. So I think that that's another way of reconciling the two.
Yes. So there is a question. What are your favorite data sources to use, both macro and quant?
For data sources, yeah, I mean, I tend to use Bloomberg, which I think is a great data source, and I use Macrobond, for economic data. Both are very good. Obviously Bloomberg is very expensive, so there are alternatives, one can use. So there's, ones like Coifin or Y charts. So there's all sorts of different sources one can use where you can kind of get cheaper sources. And obviously, if you're in an academic setting, you can get hold of all of the data a lot more easily. But for financial time series, I tend to find Bloomberg's very good overall for financial time series and high frequency data. And I find that Macrobond or Haver are very good for economic data.
Do you have a view on in which asset class macro models are most successful? FX, fixed income, commodities, or equities?
No, that's a good question. I mean, I think it depends which period you're talking about. There's been periods where FX has done really well. In recent years, FX has really struggled from a modeling perspective. Commodities, I think, lend themselves very well to macro models because they follow the business cycle very closely. Equities, I think, again, varies a lot, on the macro side. So I think they can work in all of those markets. But I think each of those markets have different phases where they've worked very, very, very well.
Is it possible to build quant models for FX markets, especially scalping models?
Yeah, of course you can. Yeah, I mean, FX, there's like a zillion different types of models that one can use. The only caveat I would say with very high frequency models is that space is very competitive. There's a lot of people in that space because FX markets are very liquid. The data is relatively easily available. So, banks have a million models out trying to arbitrage all of these, markets. So it's quite a challenging market to be in. But FX lends itself quite well to these types of models.
For tracking revised dates and data changes, have you used Temporal databases to help manage, and any recommendations?
Yeah, I'm not sure what a Temporal database is. I have someone in my team who works on the database side, so I should really ask him. So I'll have to pass on that.
There is, what are the most successful with macro data, in your opinion? There is a comment, actually. I'm guessing FX fixed income. That's
yeah, I kind of touched on this earlier. I mean, I think, in general, macro, in theory, should work best for FX rates and commodities because they're very tied to the business cycle, and equities and credit, to some extent, less so because there's much more micro data, like earnings data, that starts to influence that. So in theory, that should be the case. Although I have found that macro models in recent years haven't worked as well in FX and fixed income, but have actually worked better in equities, ironically.
Any other questions? And people are being a bit shy, so perhaps you can raise your hand if you would like to ask your own question. So trying to see if someone would like to ask a question, not in the chat, but live. That would hopefully help us live in the discussion. That's
okay. I mean, one thing I did want to mention is Macro Hive, just what we do as an organization. We have an in-house research team. We also collaborate a lot with external researchers as well. And we have different research offerings. One is we have a website where we show some of our research and we summarize academic papers, both on the macro side and the quant side. So every week we summarize an academic paper, which we think is relevant for investors. Now, normally there's kind of a charge, a monthly charge, for the website. It's like $30-40 a month. But, for this audience, I'm more than happy to give everybody a 3-month free trial, a 3-month free subscription to the site, so you can play around and look at the archive and so on. So if people are interested in that, they can just message me to get free access to the site and everything.
So there is, I think, a thank you from Alex. And
okay, yeah.
Any other questions? Any other points? So you've heard the offer, so you can contact Bilal if you would like to subscribe.
Yeah, you can just message. I'm on LinkedIn and stuff. So yeah. Oh, there's a question. Are there enough job opportunities in quant history? There are lots of job opportunities. I think quant is the space to be in. In general. So there are opportunities, but it's competitive. So because it's a global labor market. So.
Any further questions? Any further questions? So if there aren't any further questions, I guess it's fair to give people maybe another minute to ask a question in case you're typing your question, or if you want to raise your hand, you can raise your hand. This is a unique opportunity to ask Bilal a question. So
while we're coming to the end of this, maybe Paul, or Saeed, do you have any recommendation on courses that you would recommend? Obviously, you guys do courses on Python, I think, so that's one you would recommend. But in general, are there courses you would recommend for quants?
I'll let Saeed speak.
If he's still there, I'm not sure if he is.
Yeah, no, sorry, I was speaking and I hadn't unmuted the mic. Apologies. Yeah, I was going to say a bit of a plug because Paul and myself, I put on the chat, we teach the quantitative developer certificate. So that's one potential. But I would say to begin with, particularly for Python, if you haven't used Python before, I'd probably go through the official Python tutorial on python.org just to get you started, just on the syntax and stuff like that. So I think coding is all about practice at the end of the day.
Yeah.
So just to add to that, we teach on MLI, which is a machine learning course, and we also teach on QDC, which is Quantitative Developer Certificate. If you want to learn programming skills, you can join our training courses. We teach KDB as well, and C++, as well as some things which are specific to electronic and algorithmic trading. I can see there is I don't want to spend too much time advertising things, but thank you very much for this opportunity. That's very kind of you, Bilal. Really appreciate that, actually. Yeah. And there is a...
has Alex raised his hand? Alex
question.
I'm unmuting Alex.
I feel like I've asked like a zillion questions already, but I think I saw Saeed in the audience, and so the question is quite topical in terms of what value do you place on sort of alternative data, and what sort of alternative data do you think works quite well for macro models?
Yeah, I mean, that's, I guess, a question for Saeed as well. And yeah, I mean, on my side, I think there is some value with alternative data. I mean, obviously during the COVID period, there's been a whole growth of, data around mobility and COVID cases and so on. So there's been some value around that, but that's very contingent on this period we're in. I'm not sure if the value in that mobility data will continue once we get past this sort of lockdown phase. The area I found actually most interesting and most impactful on the alternative data side in the macro has been on the natural language processing side of converting, text to to variables. So, whether it's central bank speeches or annual reports, all of those sorts of things, I find that's the area I think which adds some incremental value on top of existing data. Other data, things like satellite images and all those sorts of things, there's, or credit card data, those sorts of things, I haven't found them to add as much value as I would have thought, because there's all sorts of noise in that series. And, when you then compare it to official data, you find that the value add isn't as much. So I think the natural language processing side, I think, is the area I think that offers the most value.
There is a comment from Raoul about data camp. So there is also data camp for data science and programming training. Are there any other questions? Okay, so there is a question from Alex.
Oh, Alex.
Sorry, I muted myself again, so I couldn't follow up about the NLP stuff. Yeah, I mean, personally, I've looked at sentiment stuff and found there's a really aggressive decay on it. Are you talking about sentiment specifically, or are you talking about more like slightly different stuff to sentiment analysis? And if so, sort of what sort of data sources do you look at for that kind of stuff?
Yeah, no, that's a good question. I mean, there is sentiment.
And sorry, to follow up with the question is, do you use this more to generate your macro model as your leading indicator, or are you talking about using this as a direct input into your quant models?
Yeah, that's a good question. I mean, it's kind of a work in progress for us at the moment. Where we have found value is that I think there is some value in looking at sentiment from central bank speeches from around the world. I mean, the issue with all this NLP stuff is that you need some kind of regular output, so you need a certain, say, central bank speaker to regularly speak, so you're able to benchmark it, over time to get a sense. You have to calibrate it. I think there is some value in that. But I think what you have to do is you need to break the sentiment or whatever you want to call it down into different buckets. So, for example, like with the central banker, are they focused? Is it sentiment related to growth? Is it related to inflation? Is it related to general uncertainty? So I think if you start to split it out, I think there's some kind of value. Then there's other things like, we've done some work inside, I know has done some work on this, where you have reports like the Beige Book in the US, and you have similar types of things in other countries where each month, the central bank or the regional central banks in countries have a written report of what's going on in their part of the country. And so extracting, information from there and comparing regions off against each other, that does often give you some leading indicator, properties. Now, in terms of, how we use those sentiment measures, I think it's tough. We haven't found at the moment, it's tough to use them directly as a trading model per se. Instead, I kind of think of it more as like a secondary, factor that is very useful for, sort of timing the cycle. It kind of is a good sort of confirmation signal almost, to give us more confidence.
Any other questions? Any other comments? Any other questions? There is a comment from Saeed who says, would agree about NLP. And any other questions? So you have a very short amount of time to raise your hand. So do raise your hand if you have a question, or type your question in the chat. So we're coming to the end of the talk. So if you have a question, raise your hand. We are going to wait for a short amount of time for you to raise your hand. There is a comment from Saeed that he enjoyed your presentation.
That's very kind, Saeed.
No, because actually there's some things which I've looked at before, but there's quite a few things which you mentioned. I like the Russell trend with the COVID data of trying to explain that. That I thought was really, really cool. I like that.
Yeah, thanks.
Any other questions or comments?
Okay, well, I mean, from my side at least, it was great giving this presentation, and enjoyed the questions as well. And once again, reach out to me if you do want that. It's a free subscription to the site, and feel free to sort of reach out to me, and we can sort of stay in touch, exchange ideas, and so on. It's it's good to be part of these communities. You know, that's kind of the value of organizations like Thalesians. So.
Okay, there are many comments in the chat with thank yous and praise for the presentation. So now that we're coming to the end, there are no raised hands. So on this, we will conclude, and we would like to thank Bilal very much for joining us today, for giving this talk, and hope to see you again next time, and hope to see Bilal again at Thalesians.
Great. Excellent. Thanks a lot. See you then. Good luck, everyone.